we're going to talk in detail more about how we choose stocks, and we put many webinars out of many varieties of topics because we've collected a lot of expertise here at Fort Pitt Capital. We have a network as well with many other people who are also passionate about helping people with their specialties. So we welcome you to reach out to us to have a conversation, large or small, when you have questions or concerns about anything that can affect your financial life. In the past, we've done healthy eating, orchids, beagles, in addition to topics that you would expect, like estate planning and social security. We have collected a lot of the questions we have ahead of time and boiled them down, but if we don't have time to address them all, we will address them in the Q&A. And we have a lot of bright men and women here. If asking questions during your webinar is not your thing, we invite you to reach out to have us help you find solutions. We show up every day and can be trusted to do what is right with your portfolios. If you're on a device, there's a way you can answer questions or ask questions during the webinar on the bottom right. And if you're on a computer, we don't have any handouts today, but that's where you would see the handouts and ask questions. So here at Fort Pitt Capital, we pride ourselves as people who are fiduciaries and money managers that make decisions in real time for clients every day. It's a large responsibility that we don't take lightly. There's a lot of data and news to analyze, and we're passionate about doing that for our clients. Our goal is to help people invest their assets and allocate their portfolios in a way that will produce optimum results for their situation and financial plans. A little bit about myself. I enjoy working with clients, and I'm a member of the Pittsburgh Chess Club. I invite anyone down there to play anytime. And also got a couple kids in high school. Another webinar I'd watch is how to prepare for college with Emily Franco. Been doing some college visits with my daughter and a lot of useful nuggets in there. So today I'd like to learn a little bit more about our presenters and talk first with Dan. Dan oversees all of our investment strategies as well as their structure and progress here at Fort Pitt. Dan, can you tell me a little bit more about your focus day to day and what got you passionate about investing in the first place?
Yeah, sure, David, and thanks to everyone for spending a little bit of time with us today. Let me tackle those in kind of reverse order there. I'd say, what really got me interested in investing would probably be some of the, my early jobs throughout high school and college. I worked for, a lot of really small businesses where I actually got some time to, spend with the actual entrepreneurs. And I was just always interested and intrigued to hear their stories about, how they came up with the business idea, how they funded their business, some of the risks that they took, et cetera. And it really got me thinking about and interested in, the prospects of being a business owner. And then as I learned more about the stock market, I realized it was pretty easy to invest in great publicly traded companies. So I really just started gravitating more towards learning as much as I could about different businesses and what metrics, were important and how to value companies. And then when I learned that, I could take that passion and use that to help people, towards a comfortable retirement and achieve their financial goals, I knew what I wanted to do with my career. As far as my focus day to day, really at a high level, it's on our overall investment process, communicating our investment philosophy, formulating our investment views on different asset classes. But just like Brian and Chris, I don't want to steal their thunder, but, I'm an analyst as well. So I spend a lot of my time, following and researching the companies we own and looking for new opportunities as well.
Terrific, Dan. Thank you for sharing that. And Brian, you conduct in-depth research and reviews of all the stocks that we hold and monitor. Can you describe your day-to-day here at Fort Pitt as an analyst and what first sparked your interest?
Absolutely, David, and welcome everyone. We're excited to have you on with us. So on a day-to-day basis, I'm kind of split between two things. One part being the trader. So I'm actually in and trading the accounts, executing trades, raising cash, investing cash. But when I'm not doing that, I'm an analyst and I'm researching and reviewing current investments, prospective investments, and really kind of just keeping an eye on the market to see what opportunities are out there, working closely with Dan and Chris. And, what really sparked my interest in investing, I think, was, when I was growing up as a kid, seeing businesses, around my hometown, seeing ones that succeeded and were really good and ones that failed. And I think really raised the question internally of, what's causing these companies to succeed or fail? Is it a great business product or service? Is it management? Is it financing? So that really sparked my interest to continue digging into it. And like Dan said, came across the stock market and saw that was really a great way to continue that knowledge gain.
Terrific. And Chris, talk to us about how you contribute to the team and what got you started.
Yeah, thank you, David. Thank you for having me, and thank you for everyone joining us today for the How We Pick Stocks webinar. So I started investing when I was 18 years old. I found the markets to be a very dynamic and challenging place to be. I'm 27 now, so almost a decade of experience in the markets, and trying to find the best companies over time has fascinated me over the years. You learn about all these different types of businesses out there, what they do, anywhere from consumer discretionary to technology, and kind of how they make the economic machine work and the world go round. So my contribution to the team consists of monitoring the securities that we own, pitching new companies, as well as aggregating data and news flow to better understand the marketplace, as well as trading the portfolios and make sure that they stay in line with our models.
Okay, great. So Dan, let's maybe start out by talking about our approach at a high level.
Yeah, I think that's a good place to kick things off. Let me start with probably the most important part of our overall investment philosophy. We counsel our clients to earn the equity premium, which is another way of saying that over time, over reasonable time horizons, stocks will outperform less volatile asset classes like cash and bonds, and we want our clients to earn that equity premium.
Okay, so with a bond, you're borrowing money and you're earning interest for a set period of time. With a stock, you're getting a dividend and participating in the price fluctuation. But spend a minute there and explain to me more about the equity premium.
Yeah, so I would say, a fairly simple concept and one that's, very well supported by history or historical outcomes. And it's not, too difficult to really think through why those results have occurred. Stocks have historically outperformed bonds and cash, and that hasn't just occurred due to random chance. It's happened because, good, well-run businesses are going to be able to generate higher rates of return for the owners of those businesses, i.e. the shareholders, than the returns that it generates for the lenders of the business or the bondholders. And if a business can't do that, then it's not a good business and it's not going to be around for very long. So that equity premium isn't earned in a nice, neat, orderly, predictable fashion. And there are certainly going to be plenty of setbacks along the way. But over multiple cycles, over a long-term horizon, that equity premium is real. It's very powerful. And again, we want our clients to earn that premium.
Okay, so those stock prices are going to fluctuate over the short term, over the long term, and go through cycles. If you hold them for the long term, the rewards can potentially outweigh some of that month-to-month fluctuation. So can you tell us a little bit more about how you make decisions when you're evaluating stocks?
Sure. I'll go into it at a high level, and I think Brian and Chris will jump in on some of the details. But I think first and foremost, we make those investment decisions through the lens of a business owner and not that of a stock trader. We really want to understand the businesses that we invest in. So we want to make sure that we understand the management team's, vision for the business. We recognize that it often takes a considerable amount of time for management to implement their plan. So we're not, reacting to every headline or to every quarterly earnings report. We're much more focused on the long-term opportunities for the companies that we own. So we're patient investors. That generally translates into long holding periods for the stocks that we own in portfolios, and also a fairly tax efficient result for our clients. I think that there's a lot of validity in the old saying that it's not what you make, but it's what you get to keep.
All right, so talk to us a little bit more about how many quarters you might need to hold a stock. So some people say, I don't have time to invest in stocks. I'd rather own a 5-year CD. And so I usually think to myself, well, 5 years, it's 20 quarters. How many quarters should an investor think they need to hold a stock?
Well, I don't think there's necessarily a perfect answer to the question of how long you need to plan to hold a stock. But, we do think that it's really important for investors to really understand their specific, time horizon for investing. I often hear prospective clients say things like, I need to be very conservative with my investment portfolio because I plan to retire in, 2 or 3 years. That doesn't really account for the fact that their, retirement phase could last for another 20 or 30 years. So it can often translate into, the ability to, or the need or both to take more risk or to allocate a much higher proportion of their portfolios to equities than they considered or planned previously. So I would say, for your question, I think for those investors that have a, definitive defined need for cash over the next 6 months or a year or maybe even 2, a CD like you mentioned or a money market fund might be a fine parking place for that cash. But for periods of 5 years, as you highlighted, we want to own stocks, we want to own businesses, and really back to my comments about wanting to earn that equity premium over reasonable time horizons. And I would say in terms of how we think about those time horizons within our investment process, as I mentioned, we're not short-term traders, we're not market timers, we're not out there chasing the latest Wall Street fad of the day. We're generally trying to analyze a company's prospects for earnings growth and cash flow generation over a 3 to 5 year time period. I think when investors try to focus too much on the very short term in terms of what's going to happen next week or month or quarter, they're going to end up being wrong much more than they're right. And on the other side of the coin, if you're trying to figure out what a company is going to earn or be worth in 20 years, that's probably just a bit too far down the road and probably not very helpful. So that 3 to 5 year outlook or time frame is really what we want to use to make investment decisions. And I would also just say that we firmly believe in just using good old-fashioned fundamental research to make those decisions. So we're analyzing things like company income statements, balance sheets. We're listening to earnings calls and investor presentations, industry events, and using that information to make those decisions.
Okay, great. So can you tell us, is there a target turnover that is something you shoot for? And what typically is the turnover for the stock strategies that you've had for the last few years?
Yeah, so we don't have a specific target for our portfolio turnover rate or some type of quota for how often we make changes in portfolios. I think Brian will cover some of the questions about some of the reasons that we may choose to sell or exit a position, but those are really all going to be governed by changes in the underlying fundamentals or for risk management purposes, rather than some type of established target for activity levels in portfolios. I will say, kind of to answer your question a bit more directly, I think if you look back over the last 5 years, our average turnover rate in portfolios has been low, generally in the 8 to 10% range. And I'd say that really goes back to some of my previous comments about being long-term patient investors, not reacting to the latest headlines or short-term performance results. And I think it's also really important to mention that the valuation, which we'll get into a bit more, is really going to be a major contributor to our buy, sell, hold type of decisions. We just feel that paying the wrong price for a business is the biggest risk that investors face, and it's very difficult to snap back from bad decisions on that front. So we do spend a lot of time, up front in identifying good companies, and we want to determine the right price to pay for those businesses.
Terrific. Thanks for sharing that, Dan. I do think today everything is now. Everybody has the phone in their pocket, right? You could place a trade at any time, but just because we're talking about trading stocks doesn't mean we do it every day. So it's interesting to hear in the strategies, maybe you only are trading 2 or 3 times a month, so not excessively. I want to come back to you to go over what you said about valuations, because I think that's an important point you made. But first, Brian, can you focus in a little bit more on the type of businesses that we like to own?
We like to own businesses that kind of have, meet 3 main criteria for us. And one of it is that the company offers a premium product or service, that product or service is delivered in an effective manner, and then that the whole process, the whole operation is guided by an experienced and proven management team. So like I said, we're really looking for companies that, have those 3, attributes combined.
Terrific. And can you elaborate a little bit more on what that looks like?
So for the premium product, we're really looking for something that has high demand, while at the same time limits, new entrants into the market. And I think we'll cover some examples of that soon. Delivered effectively, we're looking at how well is the business run? Is it run efficiently? Do they have a proven record of meeting demand? It's one thing to have a really nice product, but if that product isn't on the shelves for people to buy, that doesn't result in income. And then, like I said, the third one is kind of an overarching experienced management team. We think they're a key factor in delivering the product and service effectively. We want people that have the experience and the know-how to tackle future problems or changes in consumer behavior. Because while we're doing this fundamental research and then looking into these companies, the management are really the ones that are sitting there and see the day-to-day flows, and we need to be able to trust them to make the decisions that they deem and we believe are prudent.
Terrific. So though you're digesting all these reports, earning reports every 90 days and inventory levels, you might not act on it all the time, but you're constantly monitoring those things, making sure things stay where you want them. Yeah. So Dan, could you give us some more examples of structural advantages with some specific companies?
Yeah, absolutely. And like always, I think some real concrete examples really help to define what we mean by these structural advantages. So here's a little slide with some graphical representations here, and I'll start with Apple. Apple has something like 2 billion iPhone users, and we'd say it's easy to conclude that that's representative of a superior product on its own. But Apple has consistently demonstrated their ability to leverage their ecosystem by selling new products and new services to their large and growing existing client base. So today Apple has a very strong services business that didn't even exist 5 or 6 years ago. And now this segment is generating something like $80 billion in revenue and extremely high, profit margins.
Yeah, and then to build off of that some more, Dan, Tim Cook once said that he wants Apple to be remembered for their contribution to healthcare. So we think that between the Apple Watch and the continued health services that they continue to offer to the consumers will be a strong avenue of business for them in the future. Companies like Apple have a large cash pile and they produce a lot of free cash flow per year. So that kind of gives them this structural or competitive advantage over peers, especially with the ecosystem of 1.5 to 2 billion users that they have access to.
Okay, and tell us a little bit about Constellation.
Absolutely. So Constellation, they're a producer of alcoholic beverages with a focus on beer. And they hold the exclusive rights to distribute Corona, Modelo, and Pacifico brands in the U.S. And these are, very strong brands. They're premium brands, and really they represent an essential monopoly in the U.S. for premium Mexican imports, which they control about 85% of this market share. And what does that work out to? It translates into significantly higher profit margins for Constellations compared to their peers.
And if I can add on to that, Dan, I think you did a good job covering that they have this premium product. But then what I also like about the company is that they deliver it effectively. And that goes back to one of the three main things we like to see. They have this large distribution network. They have the connections with the distributors and with the sellers. And so they're able to not only make a good product, but then get that product in the hands of the consumers. So those two things combined are really advantageous.
Right. Terrific. And tell us a little bit more about what you see John Deere doing well.
Absolutely. I think John Deere is just a fabulous example of what we're talking about here. So in our view, John Deere is just revolutionizing the agricultural industry really through technology and automation. And what do I mean by that? Things like autonomous driving and automated seed placement and spacing. So those types of things help farmers to save on operational costs, and it helps them to increase their crop yield. So really at the end of the day, that translates into a lower cost of ownership for a piece of machinery for those farmers.
Certainly, Dan. And then to build off of that even more, agriculture in general is becoming more important than ever with our growing population. And you even saw this coming out of COVID between 2020 and 2021, that we need our farmers and we need our crops to start becoming more efficient. So over time, the agribusiness is certainly an interesting place of the market to be. And including the rebuild of Ukraine, seed manufacturers and equipment manufacturers are going to need to send those kind of items over there. So Ukraine's going to have to rebuild their crops and rebuild their economy over time. So we think it's a very interesting area of the market to look at.
Okay, great. So Brian, tell us a little bit more about how you look for these businesses. So how do you find them? How much do you guys read? How do you discover them?
Yeah. So we really kind of take a two-pronged approach to this. And the first part is, we use a high-level quantitative screens to identify companies that, will most likely fall into our investment criteria. And then once we, limit down the number of companies we're interested in, because there's hundreds, if not thousands of companies of, you could potentially invest in. Once we have that list narrowed down, we then dig in deep. Like Dan said, we're fundamental analysts. We're understanding the product, we're understanding the business, how they operate, and that includes reading financial statements and listening to calls. But like I said, the first step is really, how do we narrow that list down? And that's through some high-level quant screening.
Okay, terrific. And talk to us about some of them, the quantitative factors you review and what you're looking for.
It's prudent to recognize that some quant factors are more important for some industries and less important for others. So it's a little dependent on what we're researching and looking at digging into. But at a high level, we kind of have four that we're really interested in. One is margins, and this is really reflective of how well they provide their product or service. This answers the question of, are they controlling costs, or are costs increasing faster than revenue? Second one, we look at our return factors. How well are they using the resources that they are working with? For instance, a business that's really efficient and effective will have a higher return on assets than competitors. We then review, their growth prospects. Is it reasonable to expect their growth to be in the coming years, depending on their historical growth, factors? If a company is only growing 1 to 3% a year for the past 10 years, is it reasonable to all of a sudden expect them to grow 10% a year? And then, we tie it all together with, the capital structure of the business. How are they financing their operations? Are they debt heavy, giving them exposure to interest rate, or are they a little bit more reliant on, equity owners?
Great, thank you. And so, Chris, what's the process or the next steps for companies that look attractive based on these quantitative metrics?
Yeah, so then we'll look at the qualitative factors as well. Qualitative factors are an important part of the business process, of the business valuation, helps develop a core focus of competencies that are not easily quantifiable. So to fully understand the business, we have to understand the core product and the core service offered and how that affects the overall revenue and earnings power of the business. Where could other avenues of revenue be generated? For instance, healthcare for Apple. We must evaluate the competitive landscape and focus on key competitors' products and services as well, because we have to see if the company we're looking at has a superior or inferior core product or service. Intangibles can be very important as well, such as patents or intellectual property for companies. Relationships with customers and vendors are a very integral part of the business process. Strong customer relationships and vendor relationships can return into stronger retention rates of customers, better pricing, better deal terms, and much more. We also like to look at the management's track record and background as well. That is very important to understand. How did they fall into the job, previous year's experience, and then how many years have they been in this role, or are they coming over from a different industry or sector? Is it going to take them a little while to get accustomed to the management role there? So these are some of the qualitative factors we look at as well.
Okay, thanks for sharing that. So Dan, once Brian and Chris find something that checks all the boxes for these things, how do you decide if you should buy it today? Can you go back to what you said before about valuation?
It does. It's a good question. First, I'd say, our goal isn't just to find good businesses, but it's also to, buy those businesses at the right price, good prices, a reasonable valuation. And, I'd say from what I've seen, this is the part that many individual investors tend to struggle with. I wouldn't make the case at all that it's incredibly difficult for individual investors to identify, good, solid businesses. But it often does take a considerable amount of work and analysis to determine, the right price to pay for that business. And by the right price, what I really mean is the price that puts the probability of success in favor of the investor. And I think it's often even harder for individual investors to be, patient and let that opportunity present itself. So I think, on this chart here, we really outline, some of our core beliefs in terms of the valuation process. First, we think that, as I mentioned earlier, overpaying for a business is the biggest risk that investors face. And I think 2021 was a really good example of what I mean here. This was really the height of the meme stock craze. Everything at home environment was going to last forever. Investors completely ignored risks and were willing to pay, very high valuations for pretty speculative businesses. And then the environment changed in 2022, and many of those high-flying stocks plummeted, 70, 80, 90%. Very difficult to recover from those types of declines, especially with businesses that don't have good fundamentals. We also believe that the best way to mitigate risk when investing in companies is through the price that you pay. If you can invest in a company at a price that's below intrinsic value or fair value, we believe that gives us a margin of safety. And that's really what we're looking for. So at the bottom of the slide here, we outlined some of the specific metrics that we use to value a stock. I'd go back to something that Brian said, kind of different for each sector or industry. But in general, we look at things like the price of a stock in relation to how much that stock is generating or expected to generate in earnings per share and cash flow. So we also compare the company's valuation to their specific industry to see if that company is cheap or expensive relative to their peers. We compare it to the broad market to see if it's cheap or expensive relative to broad market like the S&P 500. And we also compare a stock's current valuation metrics to its own historical average valuations over multiple time periods to try to determine or answer the question of is this stock cheap or expensive today?
Okay.
So lots of work goes into our valuation process, but it's because we view it as just critically important. We look for that margin of safety that I mentioned, and again, it often takes some patience for that opportunity to come along.
Terrific. So Dan, can you walk us through a little more on the bottom of the slide? I know I heard price to earnings ratio, right? What a company's expected to earn. But what are the other two below there as well, the PCF and the PB?
Yeah, so the second one is the price of the stock in relation to how much cash flow that the company generates. And, we like cash flow. It's hard to skew cash flow. It's hard to, mitigate those numbers. We like companies that put a lot of cash in the bank every year. And the one at the bottom is price to the book value of a company's equity. So yeah, those are a few of the metrics that we use. But I think, again, as I mentioned, it's kind of important to be able to kind of rotate those valuations depending on what sector that you're looking at.
Terrific. So going back to what you said at the beginning of the equity premium, right? The PE ratio, these earnings are expected earnings. That might happen, that might not happen. And then when you look at the price of the cash flow, how are they actually doing? How are they executing? Is management living up to what you said you were monitoring? And then, as you're reading in these companies, they might take on debt to build a company or acquire another company. So what is their valuation depending on the actions that they've taken, and do you want to stay in there? So thank you for going into more detail there. Brian, so it sounds like we're able to find a lot of companies that are able to do well and grow. Why not just own the S&P 500? Why do we need to buy individual stocks instead of just trying to own them all?
There's really, 2 points that I kind of want to cover, regarding that question. And one is, first off, you're making the assumption. I mean, there's a really small chance that we're going to like all 500 companies in the index. But when you're owning just the index, you're owning companies simply because they're in the index, not because you like them or what. There's no option. If it's in the index, you own them. The second one is that the S&P 500 is a market cap weighted index. What that means is that companies that have done really well and grown their market price, are the heaviest weighted stocks in that index. And you're essentially making the assumption that, well, hey, this stock has done well in the past, so it's got to do well in the future. And that's just not an investment approach that, we're comfortable or believe investors should take.
Perfect. So Dan, tell us, what advantages does owning a strategy with, say, 30, 35 stocks have over owning an index?
Well, first I would say, like everyone else, we firmly believe in diversification and managing diversified portfolios. We want to be invested in enough companies in order to gain exposure to different market sectors and also to be able to spread our risk around or to mitigate our risk exposures. But at the same time, we don't want to be over diversified and hold, tiny inconsequential positions in hundreds of stocks. And I think if you just think about that, if a portfolio manager or an investor, hits an absolute home run, they pick a stock that triples in value, well, that could be meaningless if, in terms of your overall portfolio returns, if that position size is extremely small. So we want our position sizes to be large enough where, our high conviction ideas actually do have an impact on those bottom line results. So we really view, a 30 to 35 stock portfolio as the right number in terms of allowing us to take a balanced stance across different areas of the market, but also where, those investment decisions actually matter.
Okay, so more meaningful position sizes for more meaningful results. So Dan, can you how you come up with those position sizes for a portfolio and touch on how they complement each other?
Sure. So I would say in terms of position sizes, our normal positioning is generally, equally weighted across the stocks that we hold in the portfolio. So to put that into, practical terms, for an all equity strategy, you could think of that as us holding 33 stocks at roughly a 3% weighting, each. There certainly are times where we'll, increase our position sizes in stocks that we feel are particularly undervalued, maybe stocks that have been oversold or where we feel the market has really reacted overreacted to kind of short-term events. And there's also times where we'll trim back the size of our holdings, especially after a really strong run of outperformance. Nothing wrong in our view with trimming the hedges a little bit, so to speak, booking some gains, and just managing position sizes from a portfolio risk management standpoint. But I really like the question about how positions complement each other, because at the end of the day, that's exactly how portfolios should be structured, right? If we could predict the future, we wouldn't need a diversified portfolio. We wouldn't want our positions to complement each other. We wouldn't need diversification. We would be, all in on the top performing stocks, but we don't know the future. No one does. And if anyone tells you they do, I'd suggest that you probably, run away pretty quickly. So in our view, a diversified collection of great businesses is really the best stance or strategy. We want to maintain that healthy mix between, value stocks and growth stocks, between, companies that are economically sensitive versus ones that are less sensitive, between, strong dividend payers and stocks that are more focused on the growth of their business.
Okay, so Dan, I heard you say it's important to hold both growth and value stocks, and that was one of the first questions, and they're starting to come across here. And the question was, for a younger investor, should I go for all growth or should I go for value? Are dividends more important? Is growth more important? But I basically just heard you say both's important, right? You want a portfolio that contains both growth stocks and value stocks, right?
We would agree with that. And I think that, last year was just a great example, and, what we're seeing this year as well, but of what we want to see in terms of that complementary nature of our allocations, right? So last year was an extremely rough year for growth, and especially, technology stocks. But, our allocation to more conservative, more defensive sectors like healthcare, especially, pharmaceutical stocks, consumer staples. I'll put energy in that list as well. That exposure really helped to buffer, the declines from our growth and tech stocks. So I think that's just a good, recent example of how we want those exposures in a portfolio to complement each other.
Okay, terrific. And another question that just came in, many are predicting a recession. How's this predict your picks, and where do you think we are in the economic cycle? So, do you, Dan, have a set playbook or time frame based on the economic cycle, or where you think we are in it, helping you decide how you move between market sectors or move between growth and value?
Yeah, so I think that's a good question, and we don't manage, a static portfolio. We do want to be able to shade our portfolio positioning based on our views and the opportunities that we see in the market. And this is where we feel it's really important for investors to know and understand their time horizon. As I mentioned earlier, kind of looking for that margin of safety when buying stocks. Well, those opportunities usually present themselves in periods of market stress and or uncertainty. Periods where other investors are willing to sell their stocks at prices below fair value because of fear and panic. Those are never comfortable time periods, but that's really when value presents itself. So we often need to be able to look past these short-term issues and focus on the long-term value prospects for our business. And for us, that can translate into rotating out of or trimming back areas that are working really well today in favor of where we think stocks are undervalued and will be the leaders in the future.
Right. Thank you. Yeah, and I think it's kind of the opposite of what we all think and do. The markets go down, or there are those turbulent times, or we do enter that part of the recession cycle, and our instinct is to do the opposite, but instead we should stay disciplined and do your homework and be confident in your research. And then if you're patient, like you say, and you wait for the right valuation, that's the time that will give you those entry points to buy the companies that you like. So, now that we talked about how we buy them and when we buy them, Brian, can we talk a little bit about how we sell them? Can you tell us how we decide to exit a position? And do you have preset prices or do you have preset valuations that you want them to achieve?
Dan did a really good job of covering, like you said, of when we're stepping into a stock, but we think it's just as important to be disciplined on the flip side, which is, when do you sell a stock or when do you trim a stock? So there's a couple instances, where we would move forward with a sale. One, and a really positive one, is, there's recent growth resulting in an overweight in the portfolio. So, what we're seeing here are valuations are likely high. And, we still really, really like the company. We still like what they offer and things like that. But from a portfolio management and risk management perspective, we're comfortable with trimming, some ones that have done really well. And like Dan said, reinvesting into ones that we think may have better potential in the near future. But then what's just as important, and one that I think some people and investors struggle with, is just accepting when maybe the investment thesis was wrong. And, being willing to say that the predictions we made or the thoughts we had about the company and its growth prospects just haven't panned out. And, we're comfortable, even at valuations that may not be the best, to step out of a stock or out of a company that we say, hey, look, things just aren't how we predicted, how they planned out. And that's one, I think, again, you have to be willing to make and admit when things like that happen. Your question, David, of, do we have preset valuations or prices? That's a yes and no kind of answer. So we definitely have some, when we initiate the investment of what we would like to see them at, what we would think would be an overvalued stock or a very, very well, richly valued stock. So we definitely have those in mind and kind of have a target set out that we're watching the price movement relevant to. But I think, again, going back to the importance of us conducting, the fundamental analysis and staying on top of news and news flows, we have to be willing to adjust, those targets a little bit to factor in new news. If a company comes out with a brand new product that's going to hit it out of the park, that most likely affects our target exit, valuation or price. So, in a long story short, David, yes and no.
Yeah, that was a really good summary, Brian. I think every investment manager has to be cognizant that they're not always going to be right. Their thesis will not always be right, but you do need to have that discipline to know when to step in and move in the opposite direction, and hopefully, learn something along the way in terms of what did we miss, what factors changed, and how we can apply that to our process going forward.
And that's what I think really is the advantages of the team, me and Chris, is, we can kind of regroup after and say, okay, what went wrong? What did we miss? And how are we able to improve future research efforts so that we limit these? But like Dan said, we're not going to get everyone right. And again, if he's the same way that people that say they can predict the future, if they say we're going to get every stock pick right, you should run the other way.
Right. So, and you guys just answered a question that came through about, lessons you might have learned recently. And I think also because you guys are on the pulse of the news and monitoring, keeping up with all these results, another question that came through is, sometimes just, because we're so close, when a stock or a sector is going to have some momentum, even if it doesn't check all your boxes, why not just buy the stock and take a ride and use that momentum? And you're going to get out of it in a short time.
Yeah, so great question. It's a very full question. So at the end of this, the question reminds me of 2020 to 2021, where you could basically put 20 names on a dartboard, throw a dart, and odds are it went up due to the macro environment that we saw. So at the end of the day, we want to stick to our core process of understanding the business and the valuation prospects of that business. The market is a place of buyers and sellers, and there's not always a reason to be a buyer or seller. So you don't always have to chase the next thing or chase momentum in equities. So chasing momentum would really go against what we do at our core here at Fort Pitt Capital. Clients trust us with their money. At the end of the day, sometimes it is all of their money. So we have to be able to properly allocate these funds to equities that we have done our due diligence on and invest their hard-earned dollars into businesses that can compound at a high rate of return over a long period of time. So at the end of the day, it might be fun to trade and chase some momentum stocks in the short term, but in the long term, companies will trade off their earnings and their free cash flow forecasted out. So we think that sticking to our core valuation process is of utmost importance.
And just doing what we do well, really well, and not worrying about the other things. Okay,
Exactly.
great. So we had a lot of great questions too, even though we're talking about stocks today, about fixed income. We'll probably do another one, how we choose bonds, another day. But, one I wanted to work in from the questions we're getting, we had a low interest rate environment for so long. And we had terrible money markets and savings at the bank, but now we're starting to see some 3s and 4s and 5s instead of fixed income products. I know we talked about the equity premium, but why wouldn't we at certain times say, okay, we're going to sell our stocks and go and take advantage of that rate in term?
Yeah, I'll jump on that one, David. First, I know we focused on our stock selection process today, but as you mentioned, we manage fixed income strategies as well, and balanced portfolios where we have some combination of stock and bond exposure. So very focused on fixed income markets as well. And I would say I agree that bonds look more attractive today compared to what we've seen over the last 10 to 12 years. Yields have come down a little bit in the last couple of months, but there's still a better value proposition than we've seen for most of the part over the last decade, especially if investors think that inflation continues to fall, which we do. And we also firmly believe that investors that are in the stage where they're depending on their portfolios for income should have enough allocated to bonds to meet their income needs for a number of years. And that puts them in a position where they're not forced to sell stocks into a market decline. They're able to fund their living expenses from their bond portfolios until the equity markets recover.
All right, terrific. So we want people to invest in the stocks for the long term, but have that solid foundation first.
As with a lot of things, a solid foundation is very important. But I'll go back to my comments about counseling our clients to earn that equity premium, and our strong view that over reasonable time horizons, the owners of good businesses or the stockholders will earn higher rates of returns than the lenders to the businesses or the bondholders, which again makes intuitive sense. A company isn't going to be able to stay in business for a very long period of time if they can't pay their owners a higher rate of return than their lenders. So I'd say that's my kind of broad answer to the question, is focus on that long-term time horizon. If the question is more of hey, should we hide out from stock market volatility in bonds, and then we'll get back into the stock market once we get the all clear signal? We could do a whole webinar on that topic, but my short answer would be trying to time the markets is the best way to wreck a well-established investment plan. I've been at this for more than 20 years, and I've never seen anybody do this successfully, or at least not consistently, consecutively, or successfully.
Okay. One more question here, Dan. So we did talk about turnover, but can you tell us just ballpark the average holding period for one of your stocks? Someone just asked, is that 2 years, 3 years? Do you have an idea of what that might be?
Yeah, I mean, it kind of depends on which strategy we're talking about, but I think in high level terms, we could probably say the averages are somewhere between 5 and 7 years.
Okay.
Which I think really kind of highlights why we do a ton of work up front, and we really want to know the businesses that we're invested in.
Terrific. And I think that's all the time we have for more questions today. There were a few about individual stocks, and we got into as much as we could in detail, but if you still have questions, do reach out to us. So I hope you were able to learn more about what we do and found 1 or 2 nuggets in the way that can help you in the future. Being a buy and hold investor is simple, but that doesn't mean it's easy. So I have all the confidence that Dan and Chris and Brian, as well as others on the Fort Pitt team, they don't just have the knowledge and the experiments, but knowledge and experience, but more importantly, the temperament to stick to our discipline and what has worked well for us in the past. And we'd love to have more conversations with you about how we pick stocks. And I'm confident, my team can always find a way to add more to your situation. So I invite you to reach out to us for more. I want to thank the panelists for joining us and talking to us about stocks today, and let you know about some of the upcoming webinars that we're having. All about trust coming up in April, and then maximizing your military and veterans benefits coming up in May. Thank you very much. I really appreciate everybody who took the time out of their day to join us. And we look forward to helping you in the future at Fort Pitt Capital in any way we can. Thank you.